Bonds and bonds terminology explained. Some terminology on bonds can be rather intimidating to most ordinary people. In the next few minutes, I will deal with some of the most common terms. Ask price. This is the price at which a seller/issuer is willing to sell a bond. This applies to other financial instruments too. The issuer can choose to make the asking price negotiable or firm. If it is negotiable, then that means the seller is willing to negotiate on the asking price. Whereas if it is firm, it means the seller bid price. This speaks of the price at which an investor is willing to buy a bond. This term is also used for other financial instruments other than bonds. It contrasts with the asking price, which is the price the seller or issuer is willing to accept when selling the bond. Credit quality. This is an assessment of the level of risk that a bond issuer, seller, has of defaulting. If the level of risk of default is higher, then the issuer has to offer a higher return. All this is assessed by the underwriters of the bond issue. Underwriters guarantee payment in case of default. Face/par value. This is the amount of money that the seller will pay the bondholder on the maturity of the bond, i.e., the end of the bond period. It is very important to know that bonds are not always issued at par. They can be issued at a discount, i.e., below par value, or they can be issued at a premium, that is above the par value. Also, know that all bonds attract interest. Issuer. This is the organization that initially sells the bond, and it is them that will repay the bond. As mentioned in one of the previous points, bonds can be resold by the bondholders, but the issuer always remains the same. Maturity. This is the day when the bond will be repaid by the issuer. Price. This is the price at which bonds are selling. Price change. This looks at the change in price in the bond when compared to a previous period. Spread. This is the difference between the ask price and bid price. Like in all market transactions, the bargaining involves the seller fighting for the buyer to increase their bid price and the buyer fighting to have the asking price reduced. The sale happens when they come to a decision on a price attractive to both sides. Volume. The number of bonds bought or sold during a given period. Yield change. This refers to the change in the bond's yield over the previous period. Yield to maturity. This refers to the total returns if you were to hold a bond and all coupons, until the maturity date. Remember that bonds can be resold during their life, so some people don't experience the yield to maturity benefits. Yield. This is the rate of return, or in layman's language, the interest the buyer will experience in buying a bond at a particular price in a given year.